So welcome back. Now we are back into the deal summary section where we want to summarize everything to account for the returns, and we account for the returns on sales and the returns on cost. So here we know that we had determined our sale price from the very start of this model to be $40 million. So we reference that there. We can just copy that and we paste it on ESF formulas here. So we are just referencing what we did before in this summary of the development pro forma. And then here we want to reference whatever the land cost was, in this case $40 million. And then the hard cost, we have to reference that. So we go equals sum. We sum all of the hard cost. We know that it includes all of these hard costs plus its contingencies. So we sum all of those. We have that in place, and the soft cost, which will be equal to the sum of all of the soft costs plus we know that we had commissions and we had the interest, which we can see it now it's filling up here, which was the accrued interest we calculated already in the cash flow waterfall schedule. So we add that, and we also add the commissions at the time. So we have that in place. So we can now take the formula here, borrow this formula for per unit and per square foot base, and we copy it here as formulas, paste it here as formulas. So the profit is going to be equal to the net proceeds plus the sum when we deduct this other cost here. So we take that, and then we can now borrow this formula on ESF, and it gives us the profit of approximately $9 million. 8,427,862. So we can see that this profit, if we go back to our cash flow waterfall, we go back to the cash flow waterfall, scroll the way up, to the sum, to the free cash flow to the firm. If we sum this amount, we will see that it's the same as the profit that was earned. So as you can see, $8,427,862. That's the same profit that we get in our deal summary section. So we can see that we've kind of modeled it very correctly. So the profit that is based on the sales, on the net proceeds, and we deduct the cost, is equivalent to the free cash flow to the equity investors. So as you can see, that's the amount there. So the returns on sales is going to be based on, we take the proportion of profit to the net proceeds. We have that amount there, and the returns on cost is going to be based on the sum of the cost is going to be based on the profit, percentage of the profits to the total cost. So as you can see, for the return on sales is approximately 22%, but the returns on cost is 28%. So this project is very profitable. And then for the output section, we want to reference our profit here. So we have to go back to determine our profit here. We can just reference it from we have to determine our peak equity. So for our profit, we'll just reference the levered free cash flow here. So that's our profits in this project. For the peak equity, we have to go back and we want to calculate the maximum equity injected. So in this case, we're gonna go by saying the minimum, since it's already a negative number, but we want the maximum of the cumulative equity balance. So we are taking the minimum of, we have to actually go by taking the negative of that amount there. So we'll make sure we're doing it right. We take the minimum of the total equity cumulative balance. So the minimum of that amount is 9.6 million. So this is the total equity that is injected into this real estate development project by both the limited and the general partners. So that's the peak equity. So we're gonna reference that in our deal summary section. So the peak equity is gonna be this amount, it's 9.6 million. And then to calculate the return on equity, it is just the ratio of the profit to the peak equity. As you can see, for this project is approximately 88%. So this is huge. Like, this is really huge. So the next thing we want to do here is just to reference